Good afternoon. This is Financial Literacy 101. I'm your host, Ross World. And today we'll be talking about the four investment strategy components that I look at sometimes when I'm trying to really figure out what company I'm going to invest in. I mean, you have companies on the NASDAQ, the New York Stock Exchange, as well as the S&P 500. So what are some of the things that I actually look at when I'm investing? Good evening, Terrell. So let me get into the four things that I actually look at. Okay, I look at the business tenets, the management tenets, the financial measures tenets, and then the value tenets, or some people may call them stakes. Now, when it comes to the business of a stock, I look how easily it can be analyzed. How easily can I deconstruct it in order to understand how the business is managed? Okay, how it was built, where the backing, all those vivid details that you will need in order to research that particular company. Because see, a lot of times people, right, who don't know a lot about investing, they just want the information like, where do I put my money at to make a lot of money, Ross World? And I'm like, it's harder than that, or it requires more time than that, or it's not just a piece of information I can have you and you go running out there and throw all your money on the stock market. You're bound to fail. Really, you are going to fail if you don't have any information, any strategy, any steps that you go about when you're researching. If you ever research a company or a public company that's on the market in order to invest in that company. See, we tend to want to always do the what? That easy thing. I don't want to look at the business tenets of this. I want you to tell me where to put my money so I can make money and go off and live a wonderful life. Well, ladies and gentlemen, it doesn't matter who's in front of you giving you financial information. I don't care who it is. Tony Robbins, Dave Ramsey, Warren Buffett, Bill Gates, Elon, whoever, billionaires, millionaires, investment tycoons, Fortune 500 companies. Listen, they all made their money in very similar ways, but probably took different roads and different avenues. But the one thing no one can guarantee you is a particular rate that's over, 15% to exponentially grow your portfolio. You have to do your research. And one of the things that you have to think about is you have to really understand companies that you're going to invest in. You have to know the makeup of that company and analyze that. Again, a lot of research for stocks who's been in the game for 20 plus years, you don't really need to do a lot of research, but it does require some. See, once you get past the business tenets of it, you need to get into the management stake. How do a company evaluate themselves? Now, granted, when a company is managing themselves and they're deciding, hey, do we keep all our profit or do we give some back to the stakeholder, to the, through the investment, people who invested in us? Where do I put my money? So you have to think about it like this. If the company is a new company who just went public, and I mean within the past, it varies 5 to 10 years, don't expect those companies to do dividends unless they had so much exponential growth that they started to, hit the ceiling of the appreciation of maybe every year they was doing 20%. Now they're only doing 8%. They're growing, but growing a lot slower. So how can we keep people investing in our company? Let's give them dividends. Okay, let's give them dividends. But if they're making so much money, think about like Apple. Apple makes a ton of money around the world. Like literally in Asia, if it's not like Samsung or a homegrown phone, most people have Apples. I've been to Japan, Cambodia, Korea, the Philippines. I seen Apples everywhere. I didn't see Samsung everywhere. I sure darn didn't see Google Pixels everywhere. But I seen Apple phones everywhere. And if you invest in Apple, either be through stash in those incremental fractional shares, or you go right for the gusto with Robinhood and buy a $200 to $300 share of Apple or shares of Apple. Okay, stock, Apple, shares means plural. Anyway. The point I'm making is this: Apple gives back dividends. They don't give back much, but they give back to treat the stakeholder, to, jingle a little bit of money in front of your face for the stakeholder? Because here's the thing, Apple is still growing. They make all sorts of products, ladies and gentlemen. They do. They make monitors and CPUs and laptops, but they call them MacBooks and all that, jazz. But they make so many products. Okay, the Apple Watch, everything. The Beats by Pro now with the Apple Ear Pods or whatever. So they make tons of money, and guess what? They give back to their stakeholders. So you have to look at the longevity of a company and see how long have they been established. How do they manage their company? Do they keep all their profits for themselves and give their CEO and board of directors huge bonuses every year and give the stakeholder nothing? Now, granted, a stakeholder can also be part of the board of directors, but I'm talking about you and I. Those people who probably got under 50 shares of Apple, are they paying out dividends even though they're making billions of dollars a year? Okay. That is how management works when it comes to you analyzing a company and, how long they've been a company, how they conduct business, what the CEOs do with the money, etc. So now you have the financial measures, the stake in the financial measures or the tenets in financial measures, okay? What is the EVA? The economic value added. So a lot of times when it comes to novice investors or intermediate investors and largely expert investors, they look at low-level companies because this is where you make the money. See, you don't make the money with Apple. You make some money, but we're talking about the money. I know, a play on words, but you make some money with Apple, but expert investors look at the low-level companies, because this is where you make the money. They look at low-level companies, but with high profit margins. And what that means is, okay, after they pay off the stakeholders and everybody else, how much profit do they have left over? How much profit do they have left over? Because after the stakeholder stake is removed from the equation, in other words, the EVA, okay, the economic value added, what is the net profit minus the expenditures involved with raising the initial capital? Okay, what is left over after they done paid all the stakeholders? What is the net profit minus the expenditures evolving with with raising the initial capital? That is the question. Okay, because calculating the EVA metrics is complex, but look, factors in more than 160 adjustments. You ever looked at Robinhood and you looked at like the bottom information? They had like alpha, beta, gamma, rho, delta, or something like that, right? Those are getting into the weeds of profit, capital, EVA. There's all sorts of tenets even involved in the metrics of one particular stock. That's why I try to tell novice investors, you can look at all of that. Very intriguing information, very interesting information, how people really break down those things. But the one thing that you can tell if a company is profitable, right, or living out in debt is look at their EPS. You go over to MarketWatch, you type in the ticker or the symbol code of that particular stock. You scroll down. If they have a positive EPS, that means they are a net positive. Okay, they're a net positive. But if you see a negative sign or a dash in front of the number, they are negative. They are in debt. They're operating out of debt. So then you may want to dive a little bit deeper, because just because a company is operating out of debt doesn't mean that they won't be profitable later on in life. Okay, this is just a tool, okay, to show someone who's researching the company, this company may be a little more riskier because they're operating out of debt and they're more at risk, okay? They're a more volatile stock, but they're more at risk of bankruptcy, okay? A bankruptcy, and again, that's another level of financial information. Just because a company goes bankrupt doesn't mean a company will go out of business. See, I'll take a great example like Boeing. Boeing will have a huge project and they will hire aircraft engineers, software engineers. They'll hire 3,000 people. Easy. Easy. They will bring people back and they will hire those people because they're experts in the field. Now, they make them sign a contract for a year to 3 years, something on those lines. If it's a small project, maybe 6 months. And those guys who sign onto the contracts, they're making six figures easy. Like they're paying them really, really well. Every 3 to 5 years, you'll hear Boeing is cutting 3,000 jobs. That's not necessarily true, ladies and gentlemen. See, news is very subjective from station to station. And you have to kind of go out and read newspapers. They get the story a little bit better than the big news media that's on TV. The little small journals, certain news segments, they kind of do better news than the network news on TV, in my opinion. Come to find out, a lot of times Boeing just don't fire or let go or give people the pink slip of 3,000 workers. It just means that the contract ended and they didn't renew the contract. So when you come on to be a contractor and you are a software engineer, let's put a spin on it. Let's make it really silly. Underwater software engineer, and they're going to pay you $450,000, and they say, hey, this job is for a year. This is what we expect you to do. Can you do it? You say yes. You start making that good money. After that contract is, the only thing that your state or the government actually accumulates is those statistics that how many people got let go, right? But it don't really tell you how many people contract ended. But on the news, it'll say, oh, Boeing fired or let pink slip 3,000 people. This is just an example, guys, okay? So we have to really know some of this information, not just what people tell us. You have to really go out and do your research. Okay, I'm gonna read your notes and I'm gonna get into my last component for investment strategies, okay? All right, we got Chris Johnson. What is factor investing? That is a whole nother video, my friend. But I'll do you one better. I will write it down, and hopefully with in the week I can get that out. Okay, so I'll write this down. We're talking about factor investing because I tend to go off script a lot of guys, and I kind of want to stay on script. I kind of want to condense these live sessions. I'll answer your questions, but not just rambling because everybody know I can go into the weeds. Okay. We also have Stephen Gardner. This is good stuff. Thanks for all the good information. Well, thank you, Stephen, for chiming in. Also, tomorrow, guys, at 2 p.m. Pacific Standard Time, I am doing an interview with Stephen. He's going to tell you guys all about infinite banking and some of the services and some of the investment strategies. That's probably not investment strategies, they're more like saving strategies. At the current moment, I'm reading this book called Taming Wall Street. And basically it's simply, I won't put the cat out the bag, but I'll give you a little information. It's simply about how to safeguard your money in a sort of insurance savings plan that will give you interest on your money anywhere from 0% to 10%, okay? But on average, it's 5 to 6%. And he's going to break that down tomorrow. So I'm not going to take this time to, tell his information. I'll give him that opportunity. But I just want you to let you know tomorrow, 2 p.m. Pacific Standard Time, me and Stephen are going to sit down and do an interview. Now, granted, we don't know. I still got to talk with him. I know he's in the chat about possibly doing this a live session. He didn't think it would be that feasible or financially, what's the word I'm looking for? We'll lose a lot of money if we did it live. But I'm looking into some things, and right after this video, I'm gonna get into it. But anyway, if not, we're gonna do a recorded session. We're gonna post it sometime tomorrow. But anyway, that's Infinite Banking with Stephen Gardner tomorrow at 2 p.m. Pacific Standard, or posted at a later date. And M, thanks for educating us. Well, thank you for actually tuning in for this live broadcast. Now, let me get back on my last one. And this one is the value tenet. We talk about intrinsic value. Anybody ever heard of the term intrinsic value? Anyone? I'll give you guys a moment to catch up. We're on Wayne Peters. Okay. Anyone? Intrinsic value. Okay, so intrinsic value is simply measuring what an asset is worth. That's it. Again, in the financial world, financial managers, bankers, accountants, CFOs, they use these words basically to shorten up their speech and to, I don't want to say it sound intelligent, but they are intelligent people, right? But it just means you're measuring the worth of an asset, intrinsic value. Okay. Let's see here. Let me look at my notes real quick. I got off track. One of the cool things you have to look at when you're measuring the intrinsic value or the measurement asset or the asset worth of an asset is, again, this is all part of a strategy that this is a component, this is an ingredient for you to go through, okay? For you to go through, because I tend to focus on long-term intrinsic value. Where do I see the company at now? Where do I see them in 10 to 20 years from now? Take, for instance, I did a video on NIO, okay, a Chinese electric car company. And it's a very, very volatile stock because they're calling it Tesla wannabe. Well, I like to mirror, simulate, mimic, copy excellence. And if a company is copying Tesla, right, and they're excellent, and not just the car industry part, but if they even mimic half of what Tesla have done in business and production, then I think they'll be profitable. But again, this is a long-term view of what I didn't see in Tesla. See, I got out of Tesla way too fast. I like to use this example. I bought some shares of Tesla at $200, sold them when Tesla hit $330, and I was very impatient. Anytime you are impatient in the investment game, you lose. You have to invest like you're playing chess. Okay, you don't invest like you're playing checkers. You will lose. You have to look at the long term. And we're talking about intrinsic value and the value tenets of a stock and shares. We're talking about the intrinsic value, how you're measuring the worth of that asset throughout the course of time. But see, the short-term influctions can really deter the way you think about a particular stock, especially if you're looking at your financial portfolio every single day. Now, if you're an expert, yes, you're probably looking at it every day. But if investing is new to you within the first 5 years, ladies and gentlemen, don't look at it every day. Buy some shares. Put your account on automatic where you're actually using DCA, dollar cost averaging, where you're buying the most shares at a lower point and the least shares at a higher point, but you continue to invest and buy shares. And when you get to a certain number, you move on and you widen your portfolio with, index, ETFs, bonds, volatile, very risky stocks, okay, and different sorts of commodities in different organizations and corporations. You just haven't want a wide spread. But that actually gets me on another topic real quick about tomorrow's session with Stephen Gardner. But it also tells me that there's so much other information out there that we are not privy to and that these guys know. And the only way for us to really have money when we really need it, like you want money now, but do you really need money now? I mean, let's be real. You need money now, but you don't need the type of money that you're going to need in retirement. That's what people don't understand. Right now, you're young, you're fun, you're under the age of 50, you're going out, you're doing great things, you're working your butt off, you're having fun, you're going to clubs, parties, events, plays, you're doing all sorts of things, right? But when you can't run no more to get that belly out the way, and you're tired of eating broccoli, right? And you're eating burgers, and you unfortunately have high blood pressure. Do you have money to cover your medical? Do you have money if you want to travel or you've been traveling all your life and you couldn't just imagine a year without you traveling? You're like, wait a minute, I don't have enough money to travel anymore? What did I do with my finances? So tomorrow's session is all about how to store up a great nest egg even in the times of a market downturn, even in the time of a recession. Because here's the thing, ladies and gentlemen, when we talk about the recession or the Great Depression of 1929, we're talking about people lost a lot of money. You see the bug eyes? They lost a lot of money, okay? During the recession, 2008, 2009 timeframe, people lost a lot of money because of the stock market. That's why there's people today who are very weary of the stock market. Here's the thing. If you under the age of 50 and we go into a recession, I wouldn't worry. Because within 5 to 6 years, the stock market probably all ready to be back on track. And then here we are 10, 12 years from the recession. And right before the coronavirus hit, the Dow was doing better than it's ever done. It's always come back double and triple the points, and everybody's making great money. So eventually this coronavirus is going to blow over, okay? And hopefully nobody else dies from it. I hope they come up with a vaccine or cure or solution or an elixir to fix it, right? But you know how I always say words, the same thing 3 or 4 times? I really work on my vocabulary or my vernacular or my lexicon. I'm not showing off, just saying I read a couple of books every now and again. Okay, so that's what we're looking at when it comes to the value tenants, all right? So my summary, I'm just going to tell you the categories that we went over for the 4 investment components. I'll read your notes and I'm going to get out of here. Today we're talking about the 4 investment strategy components that I use sometimes. This is not the only strategy. This is one of them. We talked about the business tenets. We talked about the management stake. We talked about the financial measures. And we also talked about the value, where we actually input the intrinsic value, okay? The measuring of the worth of an asset, okay? We talked about business, how the business is structured. How can we analyze that business? How do we deconstruct it to see the value over a long term, okay? Again, these 4 things I named are pieces of a pie. This is a piece of a puzzle, and you have to put them all in together to be complete. These are just ingredients. See, you can't make apple pie without apples. You can't make apple pie without the crust. It's going to just be baked apples. So these are ingredients of a strategy, okay? We also talk about management. Basically, does a company pocket all the profit, or do they give money back out to their shareholders? Which one do you like? Did you read their historical history? How do they start? Where are their innovation? What inventions they're coming up with? Because they may need that money, right? They may need that money that they're pocketing to make more products. And making more products may appreciate the value of their stock. So that's why they probably pocket all the money. So you have to look at that as well. Not just saying, oh, they're not paying me dividends, so that's not a good company. It doesn't mean that. There's so many variables, ladies and gentlemen. And then lastly, financial measures. How financially do they really add up? And that's when I get into the EPS of things. Very simple information. Okay. All right, I'm going to read your notes, ladies and gentlemen, and then I'm going to tell you to have a good evening. What if I spoke like that? Wayne Peterson, definitely be up the show at 2 p.m. That's if we have it, Wayne. We still don't know yet. And then, let's see here. Chris Johnson, dollar cost averaging is a powerful tool. Indeed, it is. And Stephen Gartner, our esteemed guest. Yes, cheerio, old chap. I'll see you tomorrow. Wayne, tomorrow will be good stuff. May not be live, but we'll get it to you, he says. All right. Cheerio, everyone. This is Financial Literacy 101, while I'm acting silly as I'm getting off the net. I almost forgot my slogan. Learn money and be inspired. You guys have a great evening. Good night.